I've been getting a lot of calls from clients, current clients, past clients, just people just trying to understand what's happening with the market.
Yeah.
I know you've been in the business for like 12 years, with BMO, now with TD. You deal with a lot of mortgages. A lot of people, we're coming in from a seller's market, which basically means, for people who don't know, means there's not enough houses for the amount of buyers. So multiple offers, properties selling over ask by a lot. Now, all of a sudden, that was like last week. All of a
Yeah.
sudden, everything's stopping. People losing their jobs. People don't know how they're going to pay their next mortgage bill. Uh, Based on your experience, I know it's just an opinion. Nobody has really a crystal ball. Where do you see the real estate market, mortgages going after we're over this pandemic?
Well, there's different things between mortgages and also where the real estate market goes with the pandemic. When it comes to mortgages, I could see a lot of clients taking a look at reamortizing their monthly payments, restructuring it, refinancing, just getting better financially. I think people learn a little bit of this here. I don't want to use the word learn, but modify their spending habits a little bit based on what has happened, to have more of a security blanket. I know in the past I had something 4 years ago that changed the way I used to live. I used to live, oh, wow, great paycheck. Oh, Mercedes Benz, this car, that car. And then things came up, and then you realize, well, a Kia is just as good as a Mercedes, and Lex is just as good. But so people are going to modify a little bit. When it comes to houses, look, I think right now there's been a supply and demand issue for the last little while, for the last 2 or 3 years, that's really driven the cost of homes in the island of Montreal. And I think, again, any houses in condo 350 and under realistically are going to continue to grow because rents themselves are very limited to be found in and around Montreal. And if they are, the cost of them there. So people wanting to get into a home that are going to be approximately the same amount that they're going to pay in rent for space, those are still going to be a premium and going to go up. What's going to hurt mostly are the homes like it did back in 2011 when the government passed a new regulation of homes over $1 million couldn't be insured and stuff like that. You're going to have a drop in higher price homes. So 750 to 1.2, 1.3 millions are going to go down. People are going to go back to work, but there's still going to be a few of them that are scared of what happens if my company during this time realized they didn't need me, or they have to restructure, or just like today, Cheesecake Factory in the States said they're not going to be able to pay their April rents. We're talking about a major food chain that you go into any Cheesecake Factory, you can't get a seat. Meanwhile, they're telling you 2 weeks into a thing or a week in the US that they can't pay the rents in a month. How many realtors, how many companies are going to be able to retake this over? So there'll be a little bit of a scare there, but the banks realistically is, once you're back working, we're here to support you guys. Banks are, from what I hear, is regulations are going to be a little less strict as they've been recently.
Yeah.
We're going to be helping out people, putting them in a better position, because if we're as strict as they've been for the last 2-3 years, where clients coming to you and they want to refinance to pay debts, and sorry, you're at 48% instead of 44%, and it's sorry, we can't help you. It's going to crash the economy. It might not crash the economy, but it's going to have a rippling effect through the economy.
Mm-hmm.
And we don't want to bring down our value of our portfolios that the banks have, So it's great that one client can't afford his house on the street, but we don't want that one client pulling down the 4 other properties around it, which are going to pull down the 10 other properties around it, which is going to be
Sure.
a 2008 US effect.
Okay, I get it. So for somebody who's calling out saying, should I buy, should I wait, what would be your opinion?
Everyone's situation is a little different. A lot of people here are going to think that it's going to start being a buyer's market again, where, but look at what's been happening here. A house goes on the market for $625, and you have 53 offers 2 weeks
I know.
ago.
56. One of them had 56.
56 offers, okay? And it's great, and it probably went for on 80,000 over asking.
Yeah.
Again, most of the time, I think in the last little while, it's been a little bit of a sales tactic where they said, let's list it for 25, 30,000 under what we should be listing it potentially at to get a market going. You're still going to get what the house is worth. The houses have not gone and lost 10% of value just because people have been off to work 2 weeks now, and it'll be 6 to 8 weeks or whatever the timeline be. It's not going to kill the value that much. Because if it does, we're going to have a huge issue of repos and who knows what's going to end up happening. I think realistically, it's if you're looking to buy, it's all based on why are you buying. So if you just got married, or you're pregnant, expecting a kid, it's necessity to move up. Okay. And I think the necessity for new immigrants that have come here in the past to buy a home is there. I think the necessity of people looking to get into a bigger home because they've outgrown their home, it's going to be there. Those people moving up and so on. So it's just going to have a trickle effect all the way along. So it's going to be a slow outturn once everything starts opening up. And then it's going to push. So if you go back, when was our Quebec election? It was like 2 years ago, where everything, March and April was a standstill, right? And then everything pushed over into August and September instead of ending in July. It was a very busy summer period because those 2 months were quiet. It's going to be the same thing. We're going to roll over. It's just going to push everything a little bit down the line. And for anyone who's made an offer to purchase, don't rush to back out of your deal. Everyone's here to support everybody here, but the properties are going to come back. There's a reason why you fell in love with that house and you made that, the plea for the house. Continue with it. There's a reason why. It's not that, oh my God, it's going to lose 20% because of 2 months or 3 months. The value is going to be there and it's going to go forward with it. And everybody who causes a panic, it has a ripple effect. It's like one guy running out of a concert and someone says, oh, there's something wrong, and then all of a sudden you have a stampede and 20 people get hurt instead 100%. Of the guy was running to the bathroom. So we just gotta be logic and speak to the experts. Your real estate agents are all there, the bankers are all there. People are there to help out and speak to neighbors. And the reason you love the house is because it was a great neighborhood, not because you could think you can make 20% return in 5 years on the property. It's a long-term thing. People ask me, well, how quickly should I pay off my mortgage? Should I take a 25-year or 30-year amortization? I used to tell them, well, how long have your parents lived in their house for? Yeah. Oh, well, they usually move every 10 years. So realistically, you got to decide between paying off your house or living in the time, Sure. So go with that house because you fell in love with it. Eventually, okay, you might lose money over the first 2 years because it went down in value, but it's a long term. You're taking a 5-year term. At the end of 5 years, your house will be worth more than what you bought for it now. And you're putting money aside to save for the future. It's not like rent where you're renting and it's disappearing.
And you're just throwing your money away. So another question, on social media, I see a lot of things where the banks are allowing their clients to defer mortgage payments. What's your take on that? What's the upside and the downside to that?
Okay, so I'm going to skip a little bit on the deferring part, and I'm going to go with, if you were to come to the bank and say, I've accumulated $10,000 in line of credit debt or credit card debt, and we go, well, how did you do that? Well, I used my line of credit or used my credit card to pay my mortgage payments because I didn't have money coming in. My salary stopped. You're paying interest at a higher interest rate on the lines of credits, and we're going to basically help you out by taking that money from the line of credit or the credit cards and put it back into your mortgage. So by deferring your mortgage payment, realistically, what you're deferring is your capital repayment, okay? So your capital repayment is not going to be made, so that's your savings portion that you're paying. The interest is going to accumulate on it. So it's the same thing as if you're to refinance, that money is going to cost you the interest over the time. Same thing that's happening here by deferring. So deferring is essentially refinancing your home, okay? But I don't think deferring your payment is the best option for a lot of clients. It's the first option is to protect your score, protect your house, is say, okay, I can't make my payment this month, so I need to defer it. But then you also have to take a look, for everyone who's deferred the payment, you have to take a look now at the long-term goal. We're not talking here, potentially, I'm hoping I'm wrong, that we're not talking about a 2 or 3 week thing here. We're probably talking about a 2 month, 2.5 month ordeal till companies get back full throttle. So you're looking here is what is it best that you at this point there, when you go back to work, is it best to take a look at your mortgage saying, hey, I owe 15 years left on it. Is it better off that I take 20,000 out, create a security blanket, or get a HELOC, but put my payments over 20 years, 25 years to make your monthly payments smaller, to that you're more stable and you're more secure? And that's where the step 2 comes into. So step one is protect your credit right away by doing it. And some people do ask that question, and there's a my mother texted me before and says, hey, there's on CTV, there's a national bank guy saying it's going to affect your credit and this and that. You know what? By not making your payments and having it show up as past due on your credit report, that's going to kill your credit. By
Sure.
making an arrangement with your bank where they're deferring it, and it's understood through the economy and through all the banks, is this is what's happening now, is that you're going to defer. And when we say defer, last account yesterday, a rough number at TD Bank was 50,000 nationwide had deferred their payments in the first week. Okay. I find that number potentially a little low, that only 50,000 did it. But again, I think that's just what has gone through the system, and there's a lot more that's going to be coming through. It's nationally around, but there is some people, I got to tell you, people are taking advantage of it. Some people that are making $1 million salaries, still working, and have $500,000 in their bank account are coming in and asking to skip their payments. This is made mostly, though, and the banks are being very strict about it. If it doesn't make sense for that purpose, they're not doing it. But the bank is not turning away somebody who lost their job, has no money in their bank accounts, is on an underdraft, and we're saying, nah, we're not letting it. I know of a client who skipped their last month's payment because just different things had happened. And then this whole economy fell. He came to the bank and said, look, I know I skipped last month. What can we do? And the bank found ways to do it for him. So the bank's not going to stick anybody out on the street by saying no. They're here to help you guys, not being saying that they might refuse certain people. I'm not saying they're going to prove it, but it has to make sense that we're doing it, and we're not going to devalue the portfolios of clients or put anybody else on the street on purpose. So we're here to help everybody, and that's what the banks are trying to do.
Okay, awesome. Last question for you. Mortgage rates, do you feel that they're going to go down? Should people lock in their rates now? What's your take on that?
Okay, so it's actually a funny question that you just asked it. Realistically, so over the last week, I've posted twice on Facebook, last Thursday and again yesterday, rate increases coming, rates are going up. And I was met with a few people going, oh, stop it. Markets are crashing. Prime rate just went down 0.5%. We're going to go to zero. Scare tactics aren't going to work was one of the comments I got from somebody.
I saw that.
And then I said, yeah. And then what happened the next day? The rates went up. Okay. And then again, last night I posted, hey guys, rates are going up. And unfortunately, some of the banks have raised the rates today. Other banks are going to follow tomorrow. Some banks haven't moved yet, but realistically, when one moves, the other move. One thing people don't correlate is that when the Bank of Canada changes or cuts prime, that's what they call their overnight lending rate. It doesn't mean the banks follow with their prime rate cuts. This time, thank God, they did the two cuts that we had 0.5%. The banks did lower their prime rates by 0.5%. Back in 2008, there was two instances where the prime rate went down by 0.5%, and the banks follows only with 0.25%. There was an instance where it went down by 0.25 back in 2000, and I would say it was 11. It went down by 0.25, and the banks followed with 0.15 the first time.
Yeah.
Then it went down again by 0.25, and TD actually followed with 0.10 only, when then other banks follow with 0.15, and TD, of course, matched the 0.15.
Yeah.
So just because the Bank of Canada is lowering the rates doesn't mean the banks are lowering the rates. But one effect that did happen with the lowering of the prime rate was 2 weeks ago, you could have got prime minus 0.90, let's say. Today, if you're doing a new application today, so not anyone who had a mortgage before, but today anyone doing a new is getting like prime minus 0.10.
Okay.
So, and you might ask me, well, why is the difference between prime minus 0.90 and prime minus 0.10? Because the banks foresee that the profitability based on the economic system is that it's probably going to go down again. We're at 0.75, the overnight lending. We're not going to go to zero, but we might go to 0.25. And the economic hasn't been hit yet. So I see it going to 0.25. Again, will the bank follow with a 0.50 reduction? We don't know. But mortgage rates have gone up, and people go, well, how? The Bank of Canada is lowered, and the stocks have fallen, and the bond rates are down. Well, the bond rates did go up. At one point, the cost of funds about a week ago were just over a week ago were 0.44, and they hit a high at 0.90 3 days later. Now they're down to roughly 0.72 this afternoon. So that's just the bond market. But so the bond market is a little bit what comes into cost of funds, but now what's driving the rate increases that we're seeing by the banks is their operational costs. The banks have not laid off any employees.
Yeah.
They've actually shifted a lot of their employees to working from home. So the spending on infrastructure to buy laptops for underwriters, credit analysis, employees from telephone banking that have had to work from home with new laptops, phone lines put in, covering cost of cellular data, just the general cost of operations have gone up, which is why it's more expensive. Also, clients deferring their monthly payments on the mortgages affects the capital flow of a bank.
Sure.
So when a bank lends out $1, we have to have $1.5 to lend out. So we always have to keep a security. So when people aren't repaying their mortgages, so for instance, we had 50,000 people, let's say, who skipped their mortgage payment. If the average mortgage payment is $1,000 a month, yeah, some might be 700, some might be 3,000. Let's just say $1,000. That's how many millions of dollars in cash flow that we're not getting, right?
That's
there
insane.
that we can re-lend back out. That's where your cost of money goes out the tree. So if everybody was $1 of mortgage payment, that's 50,000 gone. $10, that's 500,000 gone. $100, that's 5 million. So you're talking in the millions of dollars of people not making capital repayments this month, which is money that would be resent out instead of borrowing, which affects the cash flow and the cost of funds.
Okay, awesome. Well, thank you so much, Brad. Thank you so much for answering these questions. Like I said, I'm getting a lot of calls. Those were the main questions people were asking. So thank you for giving me your time. I know you must be super busy to answer those questions. And as always, if I have anything else, if I have other questions that come up from my clients, I'll definitely drop a line. And I know I'll always get the right answer from you. So thank you very much, Brad.
Not a problem. I appreciate the opportunity to express my feelings to everybody. Stay safe, guys. If you do need anything, please feel free to call me and ask me any questions on Facebook that you guys want. I'm here to answer. All the best,
Awesome.
guys.
Thank you.
Thank you.
Bye.